It's a pleasure to be back in Helena, the site of the only branch office of the Federal Reserve Bank of Minneapolis. What I'm going to do, I'm going to be brief in my opening remarks. I'm going to kick things off with some basics about the Federal Reserve System and some thoughts about Fed history. But really the plan is for us to spend the bulk of our time this evening on your questions. One key point before I proceed: the views I express today are my own and not necessarily those of others in the Federal Reserve System, including my colleagues in the FOMC. And if they were here, they would be endorsing that view. Yes. In terms of basics about the Fed, I like to tell people that the Fed is a uniquely American institution. And what do I mean when I say that? Well, relative to its counterparts around the world, the U.S. central bank is highly decentralized. The Federal Reserve Bank of Minneapolis is one of 12 regional reserve banks that, along with the Board of Governors in Washington, D.C., make up the Federal Reserve System. Our bank represents the 9th of the 12 Federal Reserve districts, and our district includes Montana, the Dakotas, Minnesota, northwestern Wisconsin, and the Upper Peninsula of Michigan. So 8 times per year, the Federal Upper Market Committee, the FOMC that Tom referred to, meets to set monetary policy over the next 6 to 7 weeks. All 12 presidents of the various regional Federal Reserve banks, including me, and the governors of the Federal Reserve Board contribute to these deliberations. However, the committee itself consists only of the governors, the president of the Federal Reserve Bank of New York, and a rotating group of 4 other presidents. So I'm one of those 4 other presidents this year. So that all the presidents and the governors attend the meetings and participate in the deliberations, but only a subset of them get to vote on policy in a given year. And this year I am a voter. In this way, the structure of the FOMC mirrors the federalist structure of our own government, because representatives from different regions of the country, various presidents, have input into FOMC deliberations. So this basic federalist structure I've just described has a long history. In fact, this year is the centennial of the opening of the 12 reserve banks and the start of the work undertaken by the Federal Reserve System. It's been a fascinating 100 years, lots of twists and turns along the way, and I'm sure that many of you have questions about that journey. The answers to all of your questions, and probably more, are on a website that the Fed has created at federalreservehistory.org. So Federal Reserve History is all one word, .org. I encourage you to visit the site. You can learn about the people, places, and events that have shaped Federal Reserve history. And I'd especially encourage you to look up Norman Holter, H-O-L-T-E-R. Mr. Holter is one of the original directors of the Minneapolis Reserve Bank, and he played the key role in a branch office being established here in Helena in 1921. Now, actually, history, I've always enjoyed reading and studying history. It's way back to when I was a small child. Actually, it's a little embarrassing. But I strongly believe that history can help policymakers make decisions in the current day. But at the same time, I do think that policymakers need to be careful in how they use history. So the monetary history of the United States, monetary history of the 1970s of the United States, is a great example of this need for care. So we have a great mix of ages in the room, but I'm sure that some of you in this room remember that inflation, the rate of growth of prices, rose at disturbingly high levels in the 1970s. Faced with this challenge, President Gerald Ford launched a national campaign, the Whip Inflation Now campaign. WIN for short. You know, it's all true. We all lived through it. The famous Broadway composer, Meredith Willson, known for the Music Man, if you know that musical, wrote a song for the WIN campaign in which he summarized the economic situation in these kitschy lyrics. So, my parents, a little segue, digression here. My parents actually came from opposite ends of the world. My dad is from India. My mom's from the United States. Despite coming from opposite ends of the world, they did have a lot of things in common. And one of the things they had in common was neither of them could carry a tune. And that has been passed on to me. So I am not going to try to sing the words to you of Meredith Willson. I will, though, tell you about those words. he summarized the economic situation in the 1970s in these catchy lyrics. Who needs inflation? Not this nation. Who's going to pass it by? You are, and so am I. Mr. Wilson's pithy characterization was spot on in 1974. But 40 years later, I would suggest that it's exactly backward. Right now, this nation needs more inflation. The Federal Reserve aims to keep the personal consumption expenditure, the PCE inflation rate, at 2% per year. But since the start of the recession almost 7 years ago, the PCE inflation rate has averaged 1.5% per year. Over the past year, it has averaged 1.6% per year, 1.6%. And I expect it to remain below 2% until 2018, so 4 years from now. The persistently below target inflation that we see in our country is a signal that the U.S. economy is not taking advantage of all available resources. If demand were sufficiently high to generate 2% inflation, then demand would be sufficiently high to allow the economy to make use of these underutilized resources. And the most important of these underutilized resources are the American people. There are many people in this country who want to work more hours, and our society is being deprived of their production. So it's fun and educational to read about the 1970s on the Fed History Gateway, and I encourage you to do so. But it's critical for monetary policymakers like myself that they'll realize that the times and the challenges that we face evolve over time, and the ones we face now are different from the ones that Mr. Wilson wrote about back in 1974. Thanks again for coming tonight, and now it's time to turn to your questions.
We have a number of questions that have been submitted, but we'd also like to invite you to send your questions via a text to 612-834-1980 or via hashtag MFedQ&A on Twitter. So please do that, and as they come in, we can also have those questions asked. But let's start with the one that's listed here. The unemployment rate is low, but people seem to be out of work or looking for jobs. How do Fed officials make sense of the labor market when making policy?
So again, I'll speak for myself here. I think the labor market is very complicated, and to understand, and what are we trying to understand exactly? So Congress has asked the Fed to make monetary policy to achieve two objectives: to promote price stability, and that's been translated into this target of 2% inflation that I referred to earlier. And the other is to promote maximum employment. And what maximum employment means is not as easy to quantify because it evolves over time. It's hit by a variety of shocks and macroeconomic changes. One variable that people have used to try to track what maximum employment means is the unemployment rate. And that's come down now to 6.2%. What's complicated is there's a number of other metrics or measures of labor market performance that have not responded as well, that have not recovered as well as the unemployment rate has. So one that I mentioned is the fraction of Americans who are working part-time that would want to work more hours. That's much more elevated relative to historical norms than the unemployment rate is at 6.2%. But don't get me wrong, 6.2% is actually still, I think, unacceptably high for the unemployment rate. Well, in the longer run, I'm anticipating the unemployment rate to come down to, and again speaking for myself, at 5.2%. But how do we know if we're close to maximum employment or not? I think the key is really in inflation. And it comes back to this story, what I was describing earlier, that what does maximum employment really mean? It's the maximum number of people we can employ without imposing unduly high price pressures. So it's the maximum people that can be employed without generating a steady inflation over 2%. So as long as inflation is running below 2%, I think we don't have a concern that we're hitting into maximum employment yet, no matter really what our labor market measures look like. So it's only if we started to see inflation running above 2 that I think have to start to think, boy, are we going above maximum or not, or is this temporary? Those kinds of questions.
Great. Well, I think it's interesting to hear that inflation may be too low. Do we know that we are measuring inflation correctly, which is the next question. It's been low for a while, but even low inflation adds up. Some prices seem higher than others.
Yeah, so this is a great question. And the Fed itself doesn't measure the inflation rate. Other parts of the government do that. So the Consumer Price Index, which you often hear about, is kept track of by the Bureau of Labor Statistics. And what we use as our inflation measure, preferred inflation measure, is the personal consumption expenditure inflation rate, which is kept track of by the Bureau of Economic Analysis, also in Washington. I think it's really important to actually look at the data and measure it, as opposed to trying to rely on one's own intuitive feel of what's going on with inflation. And that's for a couple of reasons. So one is just psychological. You go to buy gas for your car, and you think, boy, the gas prices are so high. It's ridiculous how high they are. That feeling in and of itself doesn't tell you how fast they've grown over the past year. And in fact, you go get your gas now, you might think, boy, the prices are high. They're actually lower than they were a year ago. Okay, and that's actually subtracting from our 2% inflation target. So I think when people are complaining about inflation being too high, even though it's actually too low, it's a signal. What I take from it is that they're feeling that their purchasing power, their incomes, are not enough to buy the goods and services out there. But the policy response to that is quite different than if inflation is too high. If their incomes aren't high enough, well, that means we need to keep accommodative monetary policy in place in order to make their incomes high enough so they can feel comfortable buying those goods and services. But yeah, are we measuring it right? I think the most important thing to say is that you measure it consistently over time. And I can tell you, there's probably hundreds of articles that have been written about how to measure inflation. And the people at the BLS and the people at the BEA are doing their best to incorporate all that information. That's as long as they're consistent and systematic about it over time, we have a consistent way to think about the rate of growth of prices.
This is a personal question. How do you interact with other presidents of the banks within the Federal Reserve? Especially if, as you said, that you have these are opinions that may not represent. So how do you interact with the other presidents?
That's something that, I became president in October 2009. Some of the presidents are like myself, former research and economists. A lot of them had worked in the Federal Reserve as research economists, but others had worked in academia. So I actually, knew them before I became president in this former life as an academic economist. So I knew those individuals, but I really didn't know what that working relationship would be like, and it's really a great one. So one aspect of it is the interaction of monetary policy. It's just great to come together with people who are so serious, so engaged, able to talk so respectfully to each other about the issues, and that's what happens at the FOMC table. The other aspect of our job is that we try to help run the Federal Reserve System, which is 24,000 employees. We're CEOs of our different banks, but we come together to think about the global issues facing the Federal Reserve System. I've learned a lot through that process, and I've learned a lot from my fellow presidents. They come from all walks of life. I've talked about the economists. Some have worked in supervision in the Federal Reserve System. Others have been very successful business people. It's great to have all those perspectives around the table. I learn a lot from everybody at meeting the FOMC table in Washington, but also in this other task that we have of trying to run the Federal Reserve System. It's very it's a fun group of people actually to learn from and hang out with. So. That's also true.
So how important is the housing industry to expansion? And will slow growth continue until the housing industry booms again?
Yeah, so, housing's been it's been a disappointment, especially over the last year. So, but let me back up for a second and talk about housing in two different forms. So sometimes when people talk about this, they're talking about residential investment and how it's growing over time. So the actual building of houses and how that evolves over time. That has been growing slowly, and especially more recently, I think that's been a cause for concern relative to the rate of growth of the economy. The other piece people talk about is housing prices. So that feeds into the demand for goods and services, because when people have more wealth in their houses, they're able to take out loans against that and be able to use that to fund purchases or to start businesses. And so on that second piece, housing prices have come back from the nadir. Their rate of growth has slowed more recently. I think some people were probably worried about how fast they were growing about a year ago, and that rate of growth is still positive, but has slowed. I think to come back on the residential investment piece, the piece about housing growing slowly, and how is that related to growth? I think if we had faster growth, we would have faster residential investment. I don't know if I would say that's because residential investment is growing faster. The problem facing the economy is the same, and it's a little counterintuitive, but interest rates are not low enough. Okay? And interest rates are at zero. How could they not be low enough? Because that's not the right way to think about whether interest rates are too low or too high. The right way to think about is in terms of whether the Fed is achieving the goals that are set for it by Congress. Are we hitting 2% inflation? Or are we hitting maximum employment? I don't think we've been hitting maximum employment successfully, and we haven't been hitting 2% inflation. Both of those seem to call for lower interest rates. And that is consistent with the idea that interest rates are actually, the problem is not that they're too low, they're actually, they're too high relative to where we'd like to set them in order to achieve our objectives. And that's consistent with, residential investment, very sensitive to interest rates, and we're not able to get the stimulus you want through that channel.
Mm-hmm. In the past, you've described that some workers were reluctant to move for jobs because they were stuck in their home. And having lived in the Detroit area before, and have many friends that actually felt that way and felt stuck in their homes and couldn't move to other jobs. Do you think that's still the case?
So this is one of those cases where, so I did say that, and then a bunch of people did research, and I found out, I wasn't right. And that happens. That's why you have people do research. And no, it's there's the question is an interesting one about what you're concerned about is that people are constrained in terms of not being able to repay their mortgages, and that makes them stay and wait and see if their house price goes back up and they're able to repay. And that people looked in the data and you just did not see that relationship work out. And some of the work was actually done by my own reserve bank. My current research director, Sam Schulhofer-Wohl, did some great work to demonstrate. This was all done throughout the system. It's very hard to sort out the causes of unemployment during this period. But one thing I think the Federal Reserve System economists and others nailed is it wasn't due to this. So, and the countervailing force is that if you're underwater far enough on your housing, then you give up on the price going up at some point as well. Mm-hmm. So,
I'm beginning to think that hanging out with a lot of presidents for Federal Reserve banks might be a lot of fun at a table. So
wow, good, yeah, that's good.
Do we have a question from the audience?
A lot of good questions from the audience. Thank you very much. I'm going to ask one that responds to a previous response from Narayana. You said American workers are an underutilized asset, aren't getting enough hours. Why is that? Not properly educated, Obamacare, other poor policy.
So this really sets up the issue exactly. So we see employment very low, we see hours low, and the question is it regulation? And certainly I hear that suggestion all the time, or is it due to I'll provide an alternative explanation that I prefer to that. And why do I think it's not regulation? Why do I think it's not the American worker is just not good enough to provide the goods and services that we need? Well, one answer to that is, boy, that happened in a hurry. 2007 to 2009, that was all because suddenly we lost all suddenly we got huge regulatory burden, and we suddenly got a huge loss of skills in the American workforce. That doesn't sound that compelling to me, But okay, let's take that possibly as being on the table. What you would see if businesses were not hiring workers because of their limited productivity is that you would see more pass-through of those extra costs that they're facing in terms of regulation, for example, into inflation. The fact that inflation is low tells you the answer to the question. Is it because of regulation? Is it because of the Affordable Care Act? The answer is no. It's because there's not enough demand for goods and services out there. If we had more demand for goods and services, companies would go out and hire more workers, and then we would have more workers working. Now, to be cautious about this, I'm not trying to say that would get us back to where we were in 2007 in terms of employment. So in 2007, about 63% of American people over the age of 16 had a job. Now that number is more like 59%. Part of that fall is due to the fact that people have aged. That's over the age of 16. We have a demographic bulge going through the economy, the baby boom moving through the economy, that is going to get older and therefore decide to not work. So that's part of the forces. And some of these supply side, what I call supply side forces, regulation, et cetera, those might be at work as well. But right now, there is room for improvement relative in terms of employment just through the stimulus of demand. And the way we know that is because inflation is as low as it is and has been as low as it has been for as long as it has and is expected to remain as low as it is for so long to come.
This next question might put you a little bit on the defensive. Why do we need the Fed? And wouldn't financial markets take care of things on their own without a central bank? And then I want to add another question to that I think probably many people in the room are asking. And I'm going to do what any self-respecting academic would do, which is to attribute it to my children, 13 and 6, and say, why do we need the penny? And shouldn't we get rid of it?
Yeah, it's interesting. The penny I won't talk about. I'll take the big picture question.
All right. Why do we need the Fed?
So, this is a great question. I think that first of all, you wouldn't have events like this, and everyone would be stuck watching NFL football. So that would be a disaster. In a more serious vein. So I talked about how the Fed was founded in 1914, and the Federal Reserve System, and it was founded to respond to a particular problem that was existing at that time, that there were periodic financial crises hitting the United States, and so those were causing declines in output, declines in employment, and bad economic times that were actually sometimes quite persistent. So if you read American economic history, you'll hear terms like the Panic of '73, the Panic of '93, Panic of '07. It was in response to that Congress set up the central bank. Central banks, because they're able to generate money, print money, are able to generate liquidity as a way to forestall these financial crises. And I think that what the Federal Reserve was able to do in 2008 and so on, 2008, 2009, was a great example of being able to mitigate, not completely eliminate, the impacts of a dangerous financial crisis. If you had not had a central bank in place, I think, wow, things would have been much worse around the world, in fact, during that time period. During more normal times, there's some sense in which you have this piece of paper called the dollar, and there's got to be somebody who gives the American people and others around the world confidence in what's going to happen to the value of that in terms of goods and services over time. And we commit to we provide that commitment, the Central Bank of the United States does, of 2% growth in prices every year. We don't hit it every year, as I've just described, but that's, somebody's going to have to do that in the government. Congress, in its wisdom, has decided to delegate that job to an independent group of technocrats, unelected technocrats like myself. And the reason for that is you look around the world, leaving the decisions about monetary policy in the hands of elected officials with short political horizons has not gone well in terms of keeping that rate of growth of prices on a stable path. And that's, so somebody would have to make that decisions, look at those decisions, make those commitments. And what's been found in the United States, but really our example has led to this around the world, is it's typically delegated away from the elected officials to, as I say, an unelected group of technocrats like myself. But I'll close with a final point, which I think is really important, is the central bank is a creature of Congress. It's a creature of you. You own the central bank. You've made the central bank. And it changes all the time. The form of the central bank, we have the DoddFrank Act had amendments. Congress is thinking about all sorts of changes for the Federal Reserve Act, even as we speak probably. And it's, that's a good process. I mean, fundamentally, we belong to you. And we're very responsive to that, and we understand that.
This next question might allude to some risk, and I thank you for acknowledging that the Fed is not risk averse. And I think the best evidence of that is that you had this town hall during a Seahawks game in Helena, Montana.
Yeah.
So clearly it worked out. So how will the Fed reverse historic increases in the monetary base since 2008 without causing severe disruption of financial markets and commerce?
Yeah, this is a problem we've given a lot of thought to within the organization. So to back up a little bit about the context here, that beginning in September of 2008, the Federal Reserve has bought a lot of assets. The reason it's longer-term assets, and the reason it's been doing that is in order to push down on longer-term interest rates. So usually when people talk about the Fed policy, they're talking about a one-day interest rate. Well, the Fed one-day interest rate went down to very close to zero in December of 2008, and we started to augment that with other policies involving the purchases of longer-term assets. Now our balance sheet has a lot of those longer-term assets on the books. Our current purchase program is we're buying $25 billion of longer-term assets. These are assets, to be clear, that are they're issued by the Treasury, are essentially backed by the Treasury. They're Fannie Mae and Freddie Mac GSE issued instruments. But and that purchase program is anticipated to end in October. Okay? But we'll still have a lot of assets on our books. So what's going to happen to those? Well, actually, we could potentially just stand pat. And the reason for that is there was the amount of as the economy grows, eventually that amount of assets will be the right amount of assets, quote unquote, for us to hold. And what does right amount mean? It means that right now, that the way we have financed the purchase of those assets is we have taken deposits from a bunch of banks. These are called bank reserves. And the amount of deposits that banks hold with us greatly exceeds the amount they need essentially to back the deposits they have from their depositors. That's going to eventually that gap is going to shrink down to a more normal range. That is the gap between what they need to hold with us and what they're actually holding with us. And the way it can happen a bunch of different ways. But one way it can happen is that simply that the economy will keep growing over time. How will the Fed damp down inflationary pressures, though? I mean, how will it, if the economy starts to experience more demand, we start to grow, we start to see inflation, how will the Fed dampen that process? Well, the answer is we can modulate that by raising the interest rate that we pay on the deposits to banks, the so-called interest on reserves. That provides an incentive to banks to keep their money with us as opposed to trying to lend it out. And that will damp down on inflationary pressures. So yeah, we have thought about this a lot, and I could go on and on about this. Actually, I think we have there is a presentation on our website that goes on for about an hour about this exact question. So very interesting, very well done. So.
Dave, do we have another question from the audience?
Yeah, lots of great questions coming in. Thanks, everyone. So on the issue of interest rates not being low enough, why is the Fed cutting back on open market operations, in effect raising interest rates? And then we've also gotten a number of questions on QE and its effectiveness. So the whole package. Good luck with that.
Wow, I'm glad I picked you to ask me the questions. So let me talk about effectiveness of asset purchase programs first of all. Had we had the ability, I believe, if we had the ability to cut interest rates further in December of 2008, I think that would have been a preferred tool. And I've certainly said this in the past, but you can see other Fed speakers have said this in the past when we've gone out and done more asset purchases. People say, well, if we could have cut rates, we would have. But the issue is, you're at your normal instrument is at zero. That is the short-term interest rate, that interbank lending rate that you usually target. And so you're forced to use this imperfect tool. I say it's imperfect because we didn't know as much about how many assets we had to buy to lower interest rates by a given amount. So we just went out and said we're going to buy, say, $25 billion in a month. We don't know how much downward pressure that puts on interest rates. And then we don't know how that's translating into the economy as a whole. We have, Chairman Bernanke, the previous chair of the Federal Reserve System, gave a speech in Jackson Hole, August of 2012, where he talked about all the evidence about asset purchases. And I think on balance, it was a good thing to do, but it's very hard to, it was not, it's not your preferred instrument. You'd want to provide stimulus the usual way that we have a much better understanding of. So, why is the question of why are we getting out of the asset purchase game? I think, in all honesty, I think that's given. And again, I'm speaking for myself. I think that's a challenging question, and I don't really have a good answer for it, to be honest. I think that given where we are with inflation, I think that it's challenging to know why we're removing stimulus from the economy at the rate we are.
Great question from the audience. I think maybe we should go with another one, Dave.
Sure. Another tough one. What is your favorite economic indicator? And why?
Well, for an economist, you have to go with GDP on this, don't you? No, I think GDP. Different indicators work well for different problems, and certainly before I took on this job, GDP was the thing you tracked, and I looked at a lot. I have to say, as a central banker, boy, inflation pretty much is a big deal, and so you want to keep your eye on that as carefully as you can. And what's hard about this job is it's not just looking at indicators. You're trying to use those indicators to formulate a picture of the future, because monetary policy is operates with a lag. It doesn't. If we act on a Wednesday, you don't see the impact in terms of employment and inflation on Thursday. It's going to take time for that to unfold. So you sort of have to have an image in your head of what the economy is going to look like after that lag is over, say a year or two down the road. So that's going to take a bunch of different indicators to put it together. I think the thing I've learned to try to do in this job is to simplify the problem of looking into the future to thinking about employment, the labor market, and thinking about inflation, as opposed to trying to forecast everything that's going on in the economy.
Right. Let's go with the next question here of has DoddFrank resulted in overregulation, thereby restricting economic recovery and growth? And maybe this is hitting close to home. It seems like we're on the verge of losing more and more small banks, and regulators don't care. What is your view on the value of community banks for the economy?
Yeah, I think I certainly get this question a lot, and I think first of all, regulators do care. I mean, I've heard a number of very prominent people in the government talk about the value of community banking. Governor Trujillo and Governor Daniel Trujillo in our own Federal Reserve System is one of our key leaders in banking issues, has spoken about the importance of community banking. I myself have spoken about the importance of community banking. It's an institution that gives, from an economics point of view, it solves an informational problem. You have people on the ground who are able to see into the value of local projects and have a better appreciation for that than somebody from the outside would. And so community banks play a big role. Over many, many years, going back to the early 80s, you see a real decline in the number of community banks. And I think that's due to a couple of things. I think regulation is playing a role on the one hand. That by itself doesn't mean that we're having overregulation, by the way, because you might learn because of the savings and loan crisis and because of the last crisis we just went through that you do need more regulation. But to the extent that you're seeing it because you're regulating banks in a way that's not promoting their safety and soundness effectively, that's a bad thing. And the other force that's out there is technology, and that technology leading to banking having more economies of scale and therefore making bigger banks more the way to go. That I think we have to be relatively comfortable with. In terms of Dodd-Frank, I think the key was that I think something had to be done. You had to write legislation to try to deal with the fact that I think under-regulation and under supervision was a key force in generating the events of 2007, 2008, 2009 that led us into the financial crisis. With hindsight, I think that more could be done to protect community banks from the regulations that are in Dodd-Frank. I think the most effective way to do that is through what would be called exemption, where Congress specifically says, banks of a particular size are not going to be subject to this regulation. If you don't do that, then what happens is, you're leaving it to the regulators, and it becomes a very challenging position then to figure out how you've imposed these sets of regulations. How are we supposed to figure out or they figure out? Minneapolis, we don't write regulations; we supervise the banks. But how do you write the regulations so as to make it work for the small banks effectively? And it's much easier if it actually is written down in legislation.
There's a lot of talk about secular stagnation
Yeah.
in the U.S. Economy. It sounds scary. What is secular stagnation? And should we be worried?
Yeah, it's a term that has lots of different definitions, and but all of them I think are bad. So that's so let me talk about some notions that people have in mind. So first of all, Larry Summers, who was in the Obama administration and earlier in the Clinton administration, I think brought this term back to life. It was a term originally used by an economist named Elvin Hansen in the 30s, who actually used to work at the University of Minnesota, but I think he was at Harvard at the time he coined it. And it was a concern that maybe this is as good as it gets. The growth we're seeing, which has been below 3 for some time, is as good as it gets in terms of growth. And that we have to learn to live with these kind of lower prospects. I mean, when Hansen was writing about it, he was obviously thinking about a even more depressed economy because he was writing in the time period of the Great Depression. So first of all, if you want to learn about secular stagnation, looking for Summers' speech on this, which he gave earlier this year at the International Monetary Fund, is a better place to start than what I'm going to say. But what it is people are worried about what are the growth prospects. And sometimes that comes from two different sources. So one is that technology will not grow as rapidly. We will not be able to innovate as effectively going forward, and so we won't have as much growth as we've had in the past. I listened to two very prominent professors talk about this at a conference I attended in Korea. Joel Mokyr at Northwestern University and Bob Gordon at Northwestern University. They both made very powerful arguments. Professor Gordon arguing for we're going to see a slowdown in growth. We've run out of innovation, run out of ideas. And Professor Mokyr arguing the opposite. Very challenging to sort out which piece is right on that. So that's one piece. The other piece is actually due to the interest rate argument I made earlier, that demand, that I've said that interest rates are stuck at being too high because we can't lower them any further. And there's a concern that, well, maybe this is a very persistent situation, and we're going to be stuck with the Fed not being, or other central banks around the world not being able to lower interest rates, and we'll have demand being too low for a long period of time. So that's the way I think about secular stagnation. There's two possible sources for it. One is that the supply is constrained because we're not innovating rapidly enough, and the other is demand is constrained because we're not able to get interest rates low enough.
In the interest of time and to get to some questions of local relevance, maybe we can jump ahead about 5 slides. And the question is that energy industries like coal, oil, and gas have a big impact on states like Montana. How do you see these industries evolving in the future?
So I think it was Yogi Berra who said this, but somebody said this, that prediction's really hard, especially about the future. And this question is really, really brings that home. You know, I think that resources are always about a race. And the race is about people get richer around the world, and we've seen an enormous elevation of living standards in the past 10 years. We forget that in this, or maybe past 20 years. We forget that in our country because we've actually had some struggles economically. But around the world, you think about China and India and their development, you're just bringing enormous numbers of people are expanding their purchasing power. So that expands the demand for energy, and that should push upward on energy prices. The countervailing force is what we see with fracking. Human beings are very smart about innovating to find new ways to get energy out of the ground and other places. And that's the race between the human capacity for innovation versus the demand we're going to see for new energy from people getting wealthier around the world. How that will be sorted out in terms of prices, I think is very hard to know. I have to say, I'm old enough now, I remember the Club of Rome reports back in the 70s. There's been consistent predictions over the years that we're going to run out of resources, we're going to start to see prices go sky high. And of course, in the 70s, this is being thought about in the context where oil prices were rising very rapidly. Mm-hmm. So far, the innovation has really tended to win this battle. But that's not a prediction about the future. We have to wait and see.
If we back up one slide, what is your outlook for the Montana economy?
Well, I'll tell you what it was in January. Our bank issued a forecast for Montana in January. And so every January we issue a forecast for each of the states in our districts. And the forecast for Montana at that point was that unemployment reached 4.9% by the end of the year, and that employment would grow at around 1.3% for the year. Montana's done a lot better than that. So unemployment is already at 4.6%, and employment has grown, I think, about that over 1% already in the first part of the year. So very good first half compared to what we expected going into the year. I think Montana is been a very strong state. You look at that unemployment rate of 4.6%. The number I mentioned earlier about the number of workers who are working part-time that would like to have more hours, that does remain elevated in Montana. So that's a sign that there's still slack in the workforce. That is, there's room for more demand, more workers to work without putting too much upward pressure on inflation.
Thank you. Dave, do you have another question?
Sure. How did your studies shape your views, and how do they influence your views today?
Yeah, I think economics is really more a way of thinking as opposed to trying to shape your views per se. It's a way to try to organize your thinking than anything else. Taking seriously, the main thing is, I was trained at the University of Chicago, and that's a place that really drives home the notion of a trade-off. And that's what you're really forced to confront all the time as an economist, is the notion of a trade-off. That an action today, it's going to have some benefit, going to have some cost, you're going to have to sort out which one is which. That sounds simple, but I remember talking to a friend of mine who was looking for a home, and she described all the attributes she would like to have in that house. And she described what she was able to pay, and I said, well, you're going to have to trade off one of those attributes against the view versus the size of the house. And she said, I don't do trade-offs. Economists do trade-offs. So I think that's the main. I think that's the main thing. You come away with the notion of disciplined, semi-disciplined, what we think of as disciplined decision-making in the face of trade-offs, and trying to set up the trade-off, and then economics is not necessarily going to tell you how to choose to resolve the trade-off, but it will tell you how to formulate the trade-off.
Dave, do you have another?
Sure. Here's a trade-off question for you. Will a higher minimum wage increase or decrease employment overall?
So this is a wonderful question because it illustrates just how much my field, economics, has changed over the last 30 or 40 years. So when I was in school, in college, we knew the answer to this question, that a higher minimum wage would lower employment. And the way we knew that is we drew a picture, S and a D, and it crossed, and then you drew a line another place, and it was, you saw there was a gap, and if you raised it, then employment would fall. So we had these pictures, and that told us the answer. In the mid-90s, this changed. Two very prominent labor economists, David Card and Alan Kruger. Alan Kruger was also worked later in the Obama administration. Did empirical work. They went out and used data to try to analyze this question. And they found, quite surprisingly, that they analyzed a case where actually increase the minimum wage in a given state actually raised employment. Now, first of all, that makes no sense. But actually, if you think about it, it depends on the market and depends on the features of the market. Because if you have a firm, a business that has so much market power in its local market for employment that it's actually forcing wages down, right? It's got a ton of market power. It doesn't have a lot of competitors for workers in its particular niche of the marketplace. So it lowers wages a lot. So much it discourages people from working. So then by raising the minimum wage, you actually bring in workers. So that's the theory. But the important part is the empirical work. And I think this has been the sea change in economics, is we don't answer questions anymore simply by drawing a picture or building a model and analyzing it that way. We have access to so much more data, so much more sophisticated econometric methodology. It's really allowed us, I think, to become more scientific about the way we think about this. So what's the answer to that question? It depends. I think it depends on the circumstances, and it's hard to. If you had I think all economists still agree, if you had a sufficiently large increase in the minimum wage, you would have a drastic reduction in employment. So, if you raise the minimum wage to $100,000 an hour, you would kill employment. But that's not what people are talking about. For the size of minimum wage increases that you would typically hear discussed in politics, political sphere, I think it's hard to know without very careful empirical work whether it's going to lower employment or raise it.
I think you may have just converted some of our students here to economics majors tonight. Let's jump to that last slide. And the question, it seems the stock market is artificially being held up or inflated. Do you see this trend continuing or a major correction coming soon?
Yeah, so, I think that asset prices are high and interest rates are low. These are sort of the same thing. So those of you who have taken economics and are taking some business will be told, you've been taught that you can say that you can either say a bond price is high or you can say a bond yield is low. It's exactly the same thing. So this is true around the world, that interest rates are very low. Some of this is because of central bank policy, but some of it is because of the fact you just go out, say, even 10 to 20 years from now, you look at the interest rates that are implied by bonds, 10 to 20 years maturity, those are very low as well. So interest rates are just very low. If interest rates are low, bond prices are high, that's going to tend to drive up the prices of all other assets, like housing, like stocks as well. So with all that said, of course, we have to keep watching for the possibility of adverse decline in stock prices, and something I at least spend a lot of time thinking about. Right at this moment, it's not. I don't see that as a real cause for concern. But it's not. But not a cause for concern. What I'm not talking about as an investor. I'm talking about as a policymaker. As a policymaker, it matters if it affects my choices. If it affects my decision about my policy variables that I have at my disposal. In particular, is it sufficiently large risk that I'm willing to actually have employment lower? So I could raise rates, maybe dampen stock prices a little bit. That would lower employment. So how do I do that trade-off? There you go.
We're going to come to a hard stop here at 8 o'clock, so I apologize for those that are joining us online, but for those of you who are here, we do have a reception outside. Please, all of you, join us and feel free to ask more questions and converse with one another, and maybe we'll even get the question about the penny answered. All right, thank you all for coming. Please join us.